Loic, great to see you. Happy New Year, and delighted to be doing another annual review with Chenavari. Been a big year, your 15th year of operations, so congratulations. What would be your key summary for 2023?
Well, 2023, as you just said, was a milestone year for the firm. The 15 year of operation. We were able to celebrate that with the whole teams, and I think we all took a step back and realized that there are very few firms in our alternative investment management space that have been able to go through the ups and downs of the past 15 years, and we're quite pleased to have done that. Now we look forward to the next 15 years with passion, with determination, with envie, and all the skill set of that team, especially given the current market conditions. We're very excited about what's coming. In 2022 and 2023, we unfortunately have been witnessing the development of fairly shocking and violent conflicts, Russia and Ukraine, and then Israel and Palestine. So for 2024, I will hope that not only those conflicts can be resolved peacefully, but that we see less violence and we live in a more peaceful world. My second wish, again, would be more hoping that we could enter 2024 in the continuation of the quite promising achievements that we've seen at COP28 in UAE, in particular all the efforts to curb climate change, to limit global warming, that they will continue this year and in the years to come. This is a cause that is quite dear to me. This is quite dear to, more generally, the team at Chenavari, and we're rolling out initiatives in that space because we'd like to contribute to make the world a bit more sustainable.
So let's look back at some developments at Chenavari in 2023. What would you refer to?
Yeah, well, in 2023, we launched our Paris office, which basically was an important development in the context of Brexit and the unforeseen consequences of Brexit. So we've rolled out not only distribution teams in Paris, but also two investment teams, one focused on financials and the other one focused on real estate debt. As far as the other development of 2023, I think I should mention that we've been kind of planting the seeds for what's coming in early 2024, and in particular we've engineered new investment solutions for our institutional investors. The first one is very much focused on Reg Cap and regulatory capital. It's what is commonly called a risk-sharing transaction. We've been investing in risk-sharing transactions since 2011 at Chenavari, and we never offered it to our institutional investors as a dedicated investment strategy. So in 2024, it will be available to investors. And we're very hopeful that, given the market environment that is very supportive for those transactions, we are very hopeful that it could be a very interesting development. We are also readying the launch of two investment strategies focused on decarbonization. As I mentioned before, this is a key theme for us, and we would like to contribute to the change that this world required in an efficient way, because obviously we are alternative investors, and we think that in alternative fixed income there's ample room to have good investment returns while combining a significant impact on the energy transition. So the first one is focused on value add in secured by real estate debt on continental Europe, managed by our team based in Paris. And the second one is focused on the supply chain of large blue chip corporates. Usually blue chip corporates are very focused on the carbon footprint, and the bulk of their carbon footprint is usually arising from the supply chain, which is called, I think, scope 3 or level 3. So basically the supply chain, suppliers of large blue chip corporates required investments to actually accelerate their energy transition to their benefit, but also to the benefit of the blue chip corporate for which they work, which will, as a consequence, reduce their carbon footprint. We have a significant pipeline of large blue chip corporate working with us and providing us a large pipeline of opportunities and deals, and that will be offered in this decarbonization strategy. So those are mainly what I call the seeds that we've planted in 2023, and those strategies will be launched early this year.
And let's now switch to looking at performance and how Chenavari navigated the markets. What would be your summary of 2023?
Yeah, well, I mean, we are in investment management, so obviously one of the key metrics is the investment performance, and I think we can say that 2023 was a good to very good vintage in terms of performance. I can't be specific about the various products in that call, but what we can say about 2023 is that obviously there's been a dramatic change in the interest rates environment, and that has been a key theme that has affected the credit market and that has pushed basically the opportunity set in alternative fixed income even stronger. We saw obviously the European and the US central bank raise rates in an unprecedented way post-COVID, and so basically that rise of interest rates, has created obviously volatility and increasing dispersion in the environment. We saw in particular in 2023 two key moments, I think, of volatility in March, when there has been a couple of actually dramas in financials. We saw the collapse of various US regional banks, notably Silicon Valley Bank, SVB, but also in Europe, the saga around Credit Suisse, which on one hand had a repercussion on contingent capital for banks in Europe, but also created opportunities because all the market widened, and some of the senior bond exposure in Credit Suisse also traded very cheap and created opportunities for us to grasp. So was the first moment of volatility around, I think that was the late Q1. And then the second moment of volatility was end of the summer, early September, where, there has been another move, which was this conviction that the rates would stay higher for longer, and that has actually created volatility in the market, which again were entry points and attractive moments for fixed income investors and credit investors as we are. Generically speaking, we can also say that 2023 we saw continued pressure on the regulatory capital of financial institutions, in particular European bank. And we saw, as a consequence, the deleveraging and capital optimization requirement contributing to the opportunities that we saw in terms of investments, whether it is in terms of regulated capital and risk-sharing transaction, whether it is in terms of primary issuance on senior and contingent capital from the bank's balance sheet, but more generally as well in the private credit space, where there's been a supply gap for a lot of the borrowers and creating a lot of opportunities for private lenders as we are.
How would you frame your outlook for 2024 on the back of what you've just been outlining on last year?
So the first thing I like to say to asset allocators or investors that I have the pleasure to meet on a regular basis is, do not overlook the fact that debt products or credit is higher in the capital structure than equity. Mm-hmm. I am absolutely convinced that 2024 requires basically agile investment managers, and I truly believe that we are, and that investment managers that are able to take advantage of volatility and dispersion, and particular dispersions of credit spreads in the current market condition. We are, in particular, absolutely convinced that we are at the end of an equity cycle and that we've entered into a credit cycle that will last for several years. We think that investors should focus on strong risk-adjusted carry, or basically, given the inflation, given the level of risk-free rates, I think for us to add alpha, we need to deliver investment solution that basically will provide investors with risk-adjusted returns that will beat those risk-free rates and that will accommodate them to not actually lose on inflation, and certainly, the higher the inflation, the higher the pressure to invest. Yeah. The higher, sitting on cash is a drag on your overall performance. So all this is very basics, but this is very important because it means that, and we see it in the early days of 2024, we see that suddenly, some high-yield corporate issuance are oversubscribed, and by a large number of time. And so there's this technical effect that suddenly people are realizing with the beginning of the year, I can't sit on cash, I need to make asset allocation that makes sense. And I am absolutely convinced that 2024 is the continuation of exciting alternative fixed income opportunity, and credit and private credits are definitely the key pillars of it.
Let's now look more specifically, and maybe you could provide some examples of where you see the opportunities within liquid tradable credit, for example. Where would you be looking at in that space?
Well, I mean, again, the space overall are attractive. Then if I should make like 2 or 3 observations, the space overall is including high yield, financials, ABS and CLOs, and obviously derivatives as well. But I just want to make maybe 2 observations. One on CLOs first. Since 2022, the issuance of CLO has been sort of very affected by what I would call the non-economical situation, where the rated notes, the spreads at which the rated notes needs to be issued on the primary market to meet investor demand, is too high to then leave an attractive arbitrage for the CLO equity investors. So to some extent, most of the issuance of CLO equity has been taken by the manager themselves, because the managers are like very keen to keep on issuing deals, but you're being paid to buy rated CLO notes. You're being subsidized. And I absolutely think that the key theme of 2023 is going to continue in 2024, which is that those rated notes at the moment are too rich, the spreads are too high. Even, if you stress them with multiples of cases of default and, scenarios that reflects the historical crisis and so on, you see that, the rated notes are very, very attractive. And so, in my opinion, we are likely to see, I don't know if it's in the next 3 months or in the next 2 years, but we are likely to see eventually a sort of a tightening of the IG notes in the CLO capital structure, maybe a slight widening of the non-IG notes in the capital structure, especially if the pickup of default rates that we expect in the leverage loan market is actually materializing. So that's my first comment on CLOs. I would add maybe another comment on the financial sectors. We're talking about banks and everything. I mean, first, there's a change of paradigm, right? We are now in an environment where interest rates are higher, and we've lived many, many, many years in very low interest rates. So the longer-awaited normalization of those rates environment has delivered a very significant improvement on the bank's fundamentals in the bank's balance sheet. In particular, the repricing of the loan book has made, I think in 2023, it's around 20% year-on-year growth in most European banks, that the net interest income has grown, 20%. So we think that European banks are entering 2024 with what we would say the best possible fundamentals, and they are actually able to face the potential macro headwinds that, of course, with the pickup of cost of risk, they're going to face. But I'll have to say also that European banks, during the COVID environment, they have taken advantage a lot of state-guaranteed schemes that were put together by the various governments. They've taken those opportunities during the pandemic to offload the weakest and most problematic exposure. And we think that this makes the European bank sector very capable to cope with any of the economic shock that we think could happen right down the line. That also explains why in 2023, the cost of risk on banks' balance sheet has remained very, very small, because there has been a sort of reallocation to those COVID-related provision, to a sort of a macro overlay. And maybe in 2024, we'll see this cost of risk on the bank's balance sheet to slightly increase to a more normalized level. But in our opinion, this should be more than offset by the level of FT profits arising from the raise of the interest rates. If we are complete on the bank side, I think one pocket of risk may arise from the commercial real estate exposure. We've seen that already in some of the Q3 results from banks. In particular, we could mention, for example, Deutsche PBB, which is the second largest exposed bank to commercial real estate. There's been a profit warning issued following provision that had to be taken against CRE. And without being specific on that name, we and our teams do expect more to come in 2024. That readjustment of real estate prices is actually having an impact on the CRE books of banks, but it's also creating opportunities, in particular when you start lending on real estate, because the concept of LTV, loan to value, the lower the value, and if you keep the constant LTV, your level of risk is actually much lower if you lend on a initial V that is lower than before. And so typically we think that that environment, real estate and commercial real estate, is creating a little bit of a risk area for bank, but is also creating lots of opportunities for some of the asset-backed lending strategies that we're pursuing.
How do you see the opportunities playing out within private credit?
Yeah, I would say that we tend to focus primarily on two sorts of opportunities. On the one hand, the rise of interest rates and the continued capital optimization from banks make that the supply of financing available in the specialty finance area, so like let's say the granular loan portfolios, so consumer finance, mortgage, residential mortgage books, and so on, leasing, auto loans, the very granular loan pools. The appetite of banks to those pools because of the capital consumption is lower. And most specialty finance originators across Europe do require private lenders to step in and help them to keep on doing warehouses of new loan origination, and sometimes to simply optimize the existing productions. So we have a significant pipeline in that area. We have long-standing relationship with specialty finance originators across Europe, and Chandra Varri will continue in 2024 to originate significant volumes of loans. I think the figure is close to 14 billion now, originated since 2011. That our funds have contributed to finance. So that's the first part of the opportunities we see for 2024. It's basically what we call specialty finance origination. The other one, and I go back to the comment I was making earlier about the V and the fact that when you do LTV lending in asset-backed finance, when there's a price decrease of the collateral, that's an attractive entry point to do new loans. And so there's a lot of real assets, whether it's real estate or whether it's transportation assets, for example, like shipping, where you can originate attractive senior loans at high single-digit, low double-digit returns, and those loans don't need to have a very long duration, right? So we think that generally speaking, the real asset-backed strategies will have a good futures in 2024, 2025 in the current environment.
What can we expect from Chandra Varri in 2024?
Well, obviously an exciting year ahead. I think the first thing is as I try to convey, the opportunity set for what we do, alternative fixed income, credit, private credit, structured finance, is actually probably one of the most exciting in the past, 10, 15 years. Clearly, we will try to grasp opportunities as they arrive. I think one of the particular things which we haven't touched is our CLO platform will continue to grow, and we expect to issue our 9th transaction, TCLO 9. We obviously will try to roll out our 15 years track record and expertise in all the long short credit opportunities that in a world where dispersion is increasing, where credit spreads is differentiated between good and bad issuers, and where the importance of fundamentals and technicals can have a dramatic impact on the directions of travel, we think that, we should be able to make a difference. So, as we have in 2023. Again, asset management is an alternative asset management even more is an industry of, first long-term relationship between LPs and the management team, but I should almost say also trust, because you empower the asset manager to really take care about your assets. And so we are excited to roll out all these investment solutions and new investment strategies that we think fit not only the market environment, but also what we think is required in the industry. So in particular, I mentioned before, like the two decarbonization investment strategies that we are focusing on. I've mentioned the risk-sharing investment strategy, which will be a new product, but our existing products as well. I mean, starting with long-short credit, more alternative investment multi-strategy that we're pursuing, but all the specialty finance and real asset-backed lending strategies. There's one key development that we're ready to launch early 2024, which will be, I think, very much a source of added value to a lot of our LPs and institutional investors in general. That's our co-investment platform. Increasingly, investors are very keen to invest in funds, but they like also to have direct access to some of the deals. And as you know, as investment managers, we have very strict concentration guidelines, and sometimes the capacity for a deal in our different investment mandate is not sufficient, and we are very glad to share that particular transactions that has gone through all our due diligence process, underwriting process with some of our close LPs. And so we're rolling out a very advanced technology platform that will allow investors to have access to those co-investments, and they'll be able to tailor their needs depending on the asset class and depending on the type of transactions. And we have strong hope that this could be a very interesting development for the firm in 2024 and in the years that follows.
Thank you so much for all of those really important insights, Loic, both on last year and on the year ahead. That's been really insightful. It would be great now to just get a key concluding thought from you, just to re-emphasize the point to your investors. What would be that final remark from you today?
Mm-hmm. Well, an environment with higher interest rates, with higher inflation, rising default rate and delinquencies, clearly goes in favor of having maybe a bit more caution in terms of the fundamentals you want to have. And so the key bullet points I would make in that summary is credit is above equity in the capital structure. Don't forget that. A lot of the investors overlook that. And in an environment like this one, basically delivering fixed income, delivering carry to your strategy is paramount. And so I would say that in terms of asset allocation, institutional investors and wealthy investors at the moment are definitely shifting their allocation from equity to all sorts of credit strategies and yield-oriented strategies. So my key message is that we are specialists of that space, and we're entering into a cycle which you could call a credit cycle to make it simple. I call it an alternative fixed income cycle because it's credit, private credit, structured finance. We're specialists. We have 80 plus people dedicated to the space. We have a 15-year track record, and we have long-standing relationship with a lot of institutional investors, and would be delighted to start working with people who go into the space right now or present alternative strategies and the new opportunities that we've discussed in more details to anyone that would have an interest.
Well, thank you very much indeed, Loic. I wish you all the best for the rest of the year.
Thank you very much. Thanks, James.